Hi everyone, my name is Robin Speziale, and I'm the national best-selling author of Market Masters. Today I'll be sharing with you How to Find Tenbagger Stocks by Peter Lynch. I love rereading the investment classics. One Up on Wall Street by Peter Lynch is one of them. On the back cover of the book it reads, "You can discover potentially successful companies before even professional analysts do. This jump on the experts is what produces tenbaggers. The stocks that appreciate tenfold or more and turn an average stock portfolio into a star performer." End quote. And who doesn't want to find tenbaggers? A couple of tenbaggers in your portfolio can help you beat the market year over year. I've been fortunate to invest in stocks that have appreciated tenfold, meaning $1,000 investment turning into $10,000. But I'm always looking for more. When I interviewed Canada's top growth investors, Jason Donville, Martin Braun, Peter Hodson, Martin Ferguson, and Ryaz Shariff for my book Market Masters, I learned from them how they went about discovering tenbaggers. These are the common lessons. They're usually small and mid-cap stocks with low stock prices, low or no dividends. They're in knowledge-based industries, for example, technology. They've just recently released new products or services. They're run by intelligent capital allocators. There's a high rate of growth in book value per share, earnings per share, and cash flow per share. As an example, Jason Donville's investment in Constellation Software is a 30-bagger. That means that a $1,000 investment turned into $30,000. There's more examples in my book, Market Masters. But back to Peter Lynch. Peter Lynch ran the Magellan Fund at Fidelity from 1977 until 1990. And his compound annual return during those 13 years was a whopping 29.2%. Remarkably, during his tenure at Fidelity, Lynch bought more than 100 tenbagger stocks, including Fannie Mae, Ford Motor, Philip Morris, Taco Bell, Dunkin' Donuts, L'Eggs, and General Mills, all household names today. But just how did Peter Lynch find those tenbagger stocks? Stocks that go up again 10 times. He offers some hints in his book, One Up on Wall Street. In quotes, "These are among my favorite investments. Small, aggressive, new enterprises that grow at 20 to 25% a year. If you choose wisely," Peter Lynch says, "this is the land of the 10 to 40 bagger stocks, and even the 200 baggers. A fast-growing company doesn't necessarily have to belong to a fast-growing industry. All it needs is the room to expand within a slow-growing industry." That was page 108 in One Up on Wall Street. Then page 83, Peter Lynch says, "The best place to begin looking for the fast grower is close to home. If not in the backyard, then down at the shopping mall, and especially wherever you happen to work." On page 109, Peter Lynch says, "There's plenty of risk in fast growers, especially in the younger companies that tend to be overzealous and underfinanced. When an underfinanced company has headaches, it usually ends in chapter 11. So," he says, "I look for the ones that have good balance sheets and are making substantial profits." Then on page 223 to 224, Lynch says, "There are 3 phases to a growth company's life. The startup phase, during which it works out the kinks in the basic business. The rapid expansion phase, during which it moves into new markets. And the mature phase, also known as the saturation phase, when it begins to prepare for the fact that there's no easy way to continue to expand. Each of these phases may last several years. The first phase is the riskiest, though, for the investor, because the success of the enterprise isn't yet established. The second phase, which is the rapid expansion phase, is the safest for the investor and also where the most money is made because the company is growing simply by duplicating its successful formula. The third phase is the most problematic because the company runs into its limitations. Other ways must be found to increase earnings. As you recheck the stock, you want to determine whether the company seems to be moving from one phase into another. Then on page 293, Lynch says, selling an outstanding fast grower because its stock seems slightly overpriced is a losing technique. Page 109, Wall Street does not look kindly on fast growers that run out of stamina and turn into slow growers. When that happens, the stocks are beaten down accordingly. The trick is figuring out when they'll stop growing and how much to pay for the growth. The last point, how much to pay for the growth, is an important one. Peter Lynch suggested a method to judge the price for growth. He called it the price to earnings to growth ratio, or the PEG ratio. Lynch said the PE ratio of any company that is fairly priced will equal its growth rate. Here's how to calculate the PEG, price to earnings to growth ratio. You take the price to earnings, the PE ratio, and you divide it by the company's annual earnings per share growth. According to Lynch, a lower PEG ratio is better, i.e. cheaper, and a higher ratio is worse, i.e. it's more expensive. And a fairly valued company will have a PEG ratio equal to 1. While Peter Lynch popularized tenbaggers, publicly explaining his methods to find them, there's two other notable investors who shared their insights on growth stocks. Those are Philip Fisher and William O'Neill. I recommend that you look up those two investors also and read their books. Thanks for watching. Please subscribe to my channel for new videos. Visit my blog on robinspeziale.com and buy my book, Market Masters. All links are in the description to this video. Happy investing, everyone.